out of the money. So, Kev, that's a tremendous beta number for 4 options. That's
Right.
almost $100 a day. And that includes Saturdays and Sundays.
Right.
It'll be coming in on that. And again, it's still slightly out of money. So, pretty good shape, I think, Kev, with that. Now, that's that. So that's the position. We still
Right.
have it. What about the earnings play? Let's look at the earnings play.
The earnings play
highlight
was
it.
relatively simple.
Okay. Here it is. The 383.90 put 1 by 2.
Right.
Or 2 by 4.
We did it it's a 1-by-2 ratio, but we did it twice. So we did it 2 by 4.
I'll analyze it so everyone can kind of see what we're talking about here. Get rid of everything now. Okay. We have lots of different things. I will hide positions. Oh, sorry. I don't want to hide positions. So where's my simulation? Let's go back. Let's do the same thing. Analyze trade. There we go. Okay, there we go. So what
And
happened?
as we talk about, when we talk about a 1-by-2 play like this, if it goes up, it's really quite simple.
Nothing. I mean, you just keep
Right.
your credit.
Right. And we did 2 for $1.30 credit each. So
Right.
that's $260. And that's how much we'll make when the day's over.
Right. And the stock, remember, the stock was right here when this all started. And the position was a put spread, 1 by 2, or in this case we did 2 of them, so that's 2 by 4. And take a look at the risk graph. The yellow line is today's closing expiration profit loss.
Right.
Now, the yellow line. So we would have been, obviously, if it would have gone to 380, Kev, we would have been happier campers, obviously, but not for our other positions. So actually, we'll take the $1.30 gain twice.
Yeah.
And 130 twice and be happy.
It's, you know what? If it moves up, it's quite simple, right? You can cover them. You can do whatever you need to do, but
That's what we did.
it's pretty simple trade on the upside.
So with the stock here yesterday, we said we don't care how high it goes. If it goes up, great. We'll just keep the $1.30 twice, or $130 twice.
Yep.
260 minus commission, and it did move up. So basically, we just stayed in this little profit area here. You can see the yellow number down here. It says
Verdi's
$260.
making a point that Chipotle actually quickly, after the news came out, dropped to $3.90 overnight. But yeah, that would have been perfect if there were options trading at the time. But
No, there won't. Yeah.
yeah,
Too bad. Yeah.
if it went to $3.90, yeah, we'd have been right around here, and that might have been a little exciting.
Might have started to kick in a little bit.
Right.
But we're okay. I mean, it didn't go down below 369, which
Nick
is
in
our
the chat is asking, why is the credit negative? Because you're buying a spread for credit. Remember that. You're buying 2 and selling 4. So you're actually buying a vertical, but you're doing it for a net credit. So just to make it, it's one of those counterintuitive plays. You actually bought a spread, but you took in money.
Kev, we bought 2 of these
Right.
for $5.50. That's $5.50 twice is $11. So we paid $11, but we collected $3.40 4 times. Right? That's
It's
12.
like $13.60.
$13.60.
Right.
So we paid 11 and collected $13.60. There's your
Right.
$2.60.
So we bought a spread, because remember, you're buying a vertical there, and you did it for a credit.
And it's 2 by 4, or what we call a ratio, 1 by 2, and that's your credit. No, absolutely. So when it is. I know it's a little counterintuitive when you're buying a spread and getting money for it.
Jimbo's asking, did we buy back the short only or buy back the spread? We didn't do anything on this because the stock went straight up, but we would have. I actually have a bid in for a dime credit for the 2 by 4. If you look at the open orders, I actually have a dime credit the other way in case it goes there, but it's it's on the upside. They're both trading like 2 pennies or something like that.
Right. And let's see on that particular.
Happy saying you got a better fill with paper money. We usually do, Happy.
Yeah, sometimes you do because
Yeah.
especially if they have
Mid-market,
like that.
yeah.
Right. Because it'll give you a fill at what's the fair value at the time. But I would imagine that even in real money, that was probably not too far from where you could get filled. Again, that's a 1 by 2, and those puts were, the volatility was really high. They were pumped up.
Chaz is asking, so you were not covered if the stock dropped. That's correct. We had 2 cash secured puts on.
Here's your downside risk right here. And again, but that was below
But remember what our
369.
break even was, Chaz.
369.
Yeah, below 370 was our risk.
Right. And we said we would be happy to own a couple hundred shares if we had to below 370 or at 369. So again, if you weren't, you wouldn't be doing this strategy, right? If you didn't, absolutely. That's a great, we have to be very transparent about what our risks are. We always look at them. The risk would be if you did buy stock at 369, you would have all the risks associated with being long stock. And that is that if it goes lower, you lose, right? If it goes higher, you make. But that's the risk with any stock. And we said, you know what? We wouldn't mind owning stock if it got that low. Because remember, we were here yesterday when the earnings, and we said, if it got that low, we wouldn't mind owning some stock. We already sort of do in terms of our 4 long calls. But yeah. So that one was pretty wild. It worked out pretty well on both sides. Again, the options we sold, if you go to options, the ones we sold yesterday at 480, we bought back for a nickel, and that was that worked out well. The 2x4 earnings play worked out fine.
That was a
that was a full winner.
Little or no stress on that one.
Yeah, 480 to 5 cents was awesome. Now we sold the 4 calls at 250, and we still have the long 4 calls. So back to our basic position, pretty simple. This one comes off today in our earnings group, and then all we'll have left is our long position.
Our 4 new stock replacement, where we've lowered our. We just sold our Apple calls.
Awesome.
So
okay.
we
so we jump in there
rolled
now?
that, which gets onto our next topic.
Yeah.
Look at how timely that is.
Exactly.
Let me move that up to our group for our latest. So here's the fun part. Here's what I'm going to have fun talking about today. This Apple trade has been a real light bulb moment, I think, for our listeners.
Right. So let's use that as an example with today's topic.
Right.
That fits in well.
Right.
Kev, let me just tell everybody, we don't have time right now to go into our gold trade, which has done really well,
right,
and a couple of our other trades. We will go through those in the later session today, okay?
Sure.
Because we don't have enough time to cover everything today, but because we want to talk about our topic. So let's tie an apple, because we did a couple more additions to that. So let's kick it off, because today's topic is trade repair and extending duration. So what better stock to use to look at? Because in this group, Kev, of what we call our option spotlight, which we go through every Wednesday afternoon in the plunge session, is a lot of them are what we call kind of trade repair or extending duration, right? So again, when a trade goes against you, what's the one thing you do have left? Well, time, right? And if you can extend the time of that trade, it gives you time to recuperate, right?
Now, everyone that's listening to our show right now, make sure you pay attention to the math here and understand what we're getting at. Because we're going to go through some math. We're going to show you some calculations that some of the questions in the chat this morning were, well, look at the negative P&L in Apple and some of these names. Well, once you put in the rolls and understand that, and I'm going to do the math for the rolls to show you, right? Because it hasn't been on that long, so I can show you what we're doing. It'll make perfect sense when we're done, right?
All right, so we'll take it slowly because,
right,
like you said, one of the first things you'll notice, you'll see these P&L open numbers and say, whoa, what's going on?
Yeah, well, those are all the open positions left.
Sometimes, Kev, I just want to take this off.
Right.
Because it's P&L open. So everybody stop for a minute. What is P&L open? That means it's just showing you the profit and loss of the open positions that you have. And that's this 10 by 10, right? It's not necessarily showing us the gain that we made, for example, on these. Right? You can see that it was a $470 gain, but that's not showing in the P&L open because that's been realized. Okay, we realized that. Now, once you realize something in the P&L open, it goes into your year-to-date P&L, which we don't even see on this page.
Right.
That's in.
You got to go back to the account statement and see profits and losses.
And go into your profits and losses.
Right. But it's 2 clicks away. It's not terrible. No. But just understand for accounting purposes that P&L open is just what it means. It's the open position. Right?
What do we have open? And right now we have long 10 calls, short 10 calls.
Right.
And that's just showing.
We have a calendar spread.
You can. And again, that's showing a loss because guess what? The long 10, Kevin, I'm going to highlight the long 10. And remember, when we bought these, I'm going to click on it. These were bought, over a month ago.
Right. And we remember, even the day we did it, though, we bought those for $475, Scott.
Right there.
But we only paid $4.25 for the calendar spread. So our net debit there was only $425.
Right. Right.
right?
We're gonna show you
And
how
now,
that
since
wide
we've
angle.
done that, we've rolled several times. You know what?